Hey everyone, Tomas Patterson here. Welcome back to another video. From my experience, I've seen a lot of confusion out there and a lot of people sitting in silence, holding this confusion to themselves, and that's regarding something very significant. Now, what this thing is their credit score. I know when I was a teenager, becoming a young adult, I had a lot of questions, but there wasn't a lot of answers out there. All I pretty much knew was that you get a credit card, that helps build your credit, and then that was that. No one told me anything else. Things like, why did I need good credit in the first place? What was a good credit score? Where do you go to check your credit score? What goes into even determining your score? All sorts of things like that. Well, if you have some confusion on that topic, whether it's big or even really small, okay, today we're going to be covering the wonderful credit score. I really wish the me back then would have stumbled across a video like this with, the helpful info I'm ready to share with you guys, because it could have made some big impacts in my life that carried forward until today. So click that like button down below, if you learned something, if you enjoy this video, and yeah, let's get into it. If you're unsure, okay, a credit report is pretty much a report that contains all your credit history, okay? So that's includes things like loans, credit cards, mortgages, lines of credit, pretty much mostly anything that you have to apply to, or if you're getting money and you're making regular payments on it. Now, on your credit report, you're gonna have a 3-digit number, and now this number is your credit score. This is a general indicator of your credit history, okay? And lenders are interested in this because it helps you determine how risky a borrower is or not. So they're gonna look at this number and determine if you're someone that they're gonna wanna give money to or not. That means if you have a history of making late payments, missing payments, or even delinquencies on your loans, chances are that these patterns, these financial habits are going to carry forward into the future. So lenders are going to think really hard whether or not you're someone that they're going to want to give their money to or not. After all, institutions are out here too to make money, okay? So if you're someone that poses a risk, well, chances are that's a risk they're not willing to take and you're going to get declined. Since the credit report gives the lender a glimpse of your past and current history, then positive behaviors on there can be used to support your application for the loan. And if you have any negative behaviors, any negative activity on there, then that opens the opportunity for the lender to ask you questions and help clarify some things. The credit score ranges from 300 to 900, okay? Where 300 is the very, very worst. That's so poor. I don't even think I've seen a score that low. And then you'd have 900 on the other end of the spectrum, which that's being immaculate, okay? So that's cause for celebration. If you have a score that high, then you're easily part of the top 1% of people there. Now, 650, that is considered the magic middle number, okay? That's the tipping point where you're actually going to qualify for a standard loan, while a lower score of, 640 below, that's going to give you trouble when trying to secure a new loan. This credit score is determined by considering multiple factors. In Canada, there are 2 national credit bureaus which compile all your credit reports, and these are either Equifax or TransUnion. So Equifax uses information provided by financial institutions, credit card companies, telecommunication companies, pretty much anywhere else that accesses credit. The score we use at the credit union where I work, that's called the CRP, and that stands for the Consumer Risk Predictor. What this score does is it predicts the likelihood of a serious delinquency within 24 months. What a better credit score is going to do for you, okay, it's going to allow you to secure better rates on your loans, your lending products. For joint products, lenders are typically going to take the average of both of the people applying for the loan, and then that average, they're going to use that for the qualifying rate of the loan. So say if you have someone with a 800 score and someone with a 700 score, the average would be 750, and that score is going to be used on the application. If a guarantor is needed, which sometimes it is, especially for younger applicants, with little to no credit history, or even applying for things such as a student line of credit, that's a most common one, okay? In this case, the loan price is based off the principal borrower's score. Now, when it comes to your credit score, this is calculated using a system of weighted categories. So the first category is the amount of debt. Okay, this is the amount of credit used and the amount of debt still owed. And this is very important for your credit score because it's a 30% weight. This considers the total amount owed across all accounts, and it even considers amounts owing to specific types. Okay, so things such as your open, which would be things like your phone bill every month, or your installment, which would be like an installment loan, say for your car or a student loan there. And then there's also revolving. So that's ongoing things like a credit card or a line of credit. The amount of debt also considers the amount of accounts you have with a balance. So if you have a lot of accounts on your credit report with a balance, then it's going to show that you're at greater risk of overextending your credit. So this also factors in your credit utilization ratio. This is the percentage of credit that you're currently using. So if you're at near credit, especially on multiple accounts, it might indicate that in the future you could be unable to pay these. The second category is length of history. This score is weighted 15% and it's impacted by how long you've had things active for on your credit report, how long it's been since you opened them, and a big part of this is the age of the oldest trade or the oldest account on your credit report. A lot of people don't realize this, and it's unfortunate because this could be the difference between the amount of points you need to get approved or get that special rate. This is why when people cut up their credit cards after paying them off or something, I cringe so hard. Yeah, I understand the logic, okay, and your reasoning behind this, but if you're 100% behind yourself and you're truly committed to getting out of debt, then you should have no problem not using that card. If just the sight of the card is something that's going to make you want to spend money, then the chances aren't looking good because in the future, you'll probably just end up getting another card. Okay, and if it's that big of a deal, then put it in a box under your bed, stuff it deep in your closet, do something. Just keep it open, but cutting it up, that's what's going to have a decently weighted impact on your credit score. Say if this card was one of, if not the only trade on your credit, and then you cancel it and don't end up getting another card for 5 years, well, you just missed out on 5 years of credit history on your credit report. You don't have to be maxing it out, okay? Just simply keeping it open and maybe just getting something every once in a while on it, like gas or a bag of chips, just to keep it open. It reflects very positive on you to have a good credit history over a long time. Me, I personally still have the first credit card I ever got when I was 18, just about to finish up high school. It's a CIBC credit card and the credit limit is still just only $1,000, okay? So some people consider that small, but to me it doesn't even matter because I consider it as money I don't own, so I'm not really even inclined to use it. It's not even a crazy card with rewards or anything like that. It's got nothing with it. I just know it's the oldest account I have on my credit report, and so it costs me nothing. So I don't want to get rid of it. I just want to keep it because it adds value to me. I think I really only have like a $5 per month automated thing that comes out of there on my credit card for Apple Music every month. And that's just to keep it open, keep it active, and I pay it off instantly. In fact, most times I even have a little credit on there from overpaying it little by little each time. So yeah, that's a big part to credit history, but keep in mind that there are other things that are also factored in, and these are things like the average age of all your credit accounts on there, as well as specific ages of the certain types of accounts. So that's coming back to the open, the revolving, and the installment. The next category is new credit. Now, this isn't as big of a deal as others lead on. It's still only 10% of the weight of your credit score, but keep in mind it's still very important. This takes into account how many new trades have been opened recently, but it also considers if you've been shopping around for rates, say for a loan or a mortgage. So by this I mean if you've been around different places, applying at these multiple places for the same things. You need to remember, whenever you're opening up new accounts, a credit card, even a phone bill, you're going to have your credit pulled. This is pretty much the first thing a lender is going to look at to determine if you're someone that they're going to want to give their money to. Even if you're just shopping around for rates for a mortgage or a loan, you're going to have your credit pulled too. What this does is it temporarily decreases your credit score by a certain amount of points, sometimes more than others. This is to show that you've been shopping around, applying to other places for rates, and it gives other lenders, like a heads up to say, hey, this person's been looking here, this person's been looking there. Maybe they might be a little on the risky side. If this weren't the case, okay, imagine someone who just barely had the credit to apply for $10,000. This might be already more than they can handle regardless. But now imagine they go to 5 other places, say 10 different places, and get this same loan because their credit score wasn't decreased from the other applications. Then next thing you know, they got 100 grand in their pocket that they have no business being lent in the first place because they have no capability to pay this back probably, okay? And they're going to end up defaulting on it. This is probably going to leave them bankrupt, okay, or a tarnished credit history, and it's going to leave the lenders with not even a penny to show for it. But keep in mind, there is a little misconception which goes back to what I was saying earlier about this not being as big of a deal as some people lead on. Credit bureaus now tend to lump multiple related inquiries. So say if over a day or maybe a few days you're shopping around to multiple auto places, they tend to lump these together as one now. This helps to not decrease your credit score as much, but keep in mind there are still other things that are going to impact your credit score. For example, if you're applying for a loan at a place that's considered a subprime lender by Equifax. Subprime loans are loans given to those with poor credit history, poor credit score, and they're viewed as more risky. And lastly, it's very important to keep in mind that your new applications for credit, those requests stay on your credit report for the next 2 years. Now, the next category that goes into composing your credit score is the credit mix. All right. Now, what this mix is, it's weighted 10% of your credit score, and this factors in all the different types of accounts you have in your credit report. Okay. So whether it's credit cards, installment loans, mortgage, line of credit. This is typically a bigger deal if there aren't that many things on your credit report, to get analytics from and to base your score on. The next category is payment history. Okay, for obvious reasons, this section has the largest weight on your credit score. It's pretty simple. If you've been known to skip payments, make payments late, or maybe not pay at all, this reflects poorly on your part. What this portion of the calculation details is how consistently your bills and your debts have been paid in the past. The more severe, the more recent, and the more frequent late payments, these have the largest effect on your credit score. Payment history is based on the different types of accounts, public records, details of late or missed payments, as well as items that are in collection. Okay, so now with how your score is calculated out of the way, I want to take a second and touch upon the difference between what a hard inquiry and what a soft inquiry is. There tends to be a lot of confusion about what the difference between the two are and how they each affect your score. A hard inquiry or a hard hit is a credit check that occurs when you go to apply for new credit. These factor into your credit score, okay? So this is what we talked about earlier, where it can have a negative impact if you're shopping around at a lot of places for credit in a short period of time. A soft inquiry or a soft hit, okay, that's when your credit score is automatically updated without applying for new credit. This could be at the bank every 6 months or whatever, when their systems are updated. With a soft hit, checking your score won't affect your score or your credit reports. It gives the same information that a hard inquiry does, so say your credit score, your payment history, your accounts, all that. And soft inquiries can happen without you even knowing, okay? It's not a big deal. There can also be a soft hit if you're requesting your own credit report. You can request a copy of your credit report from Equifax by either on the phone, in person, or by mail. If you're requesting it by phone, you're going to have to enter your social insurance number. And if you request it by mail, you're going to have to issue some supporting documents, such as ones that help with your identity and your address. You might have even heard of websites that help you check your credit for free, okay? So Credit Karma, things like that, Borrowwell. Well, these also count as a soft hit, okay? They're not going to affect your score. However, it's very, very, very important that you understand what I'm about to tell you, because a lot of people don't, and it can be the cause for a lot of shock, disappointment, even embarrassment when they go to apply for a loan. When you use services to check your credit, okay, they have authorization to have access to your credit reports, but the score they tell you is not right. I'm going to repeat that. The score that you get on websites like Credit Karma and Borrowwell, okay, that credit score is not accurate. It's generally a good indicator, okay? It tends to be close, but at times, even often, the scores can differ by a lot of points, 10, 20, 30, even 50 points. So that's why it's a good idea to get your actual credit score when you need to from Equifax themselves. The reason these scores are not accurate is because, like Equifax, they use an algorithm to determine your credit score. Kind of like how YouTube uses an algorithm to rank videos. So if you're still watching this, hit that like button. It really helps my video with the algorithm. Thank you. But yeah, as I was saying, Equifax has an algorithm, but these other entities, they have their own algorithms. Now, don't get me wrong, it could be real similar, okay? They want to get it as accurate as they can. They can even call it things like Equifax 2.0 algorithm or whatever. But in reality, these are not the exact metrics that are used into calculating your actual credit score. And it is for this reason that you shouldn't base all your strategies, okay, your options and your decisions in life based off the score that you're getting on these websites. Your score could actually end up being lower than it actually is, or maybe the website is understating it and you've been limiting yourself all this time by not going and applying for that loan you wanted. It's okay to try and gauge your progress and kind of see how well you've been doing. And you can even see the individual items on your credit report and the status of them. You can even look at general patterns to see whether your positive or your negative behavior is reflected in the score that they're telling you. But other than that, I would not spend too much time with these things. At a bank or a credit union, you're not allowed to get handed your credit report. It's against the law for them to do this. But you can always probably ask them for your score or even receive coaching, based on the information on there, or at least directions on where to properly get your credit report. Also, keep in mind that your credit score can vary from institution to institution, okay? So if your credit score at RBC differs from then what it is at TD or the auto place you just applied for, this can be due to a few factors. For example, it could be a few or several days between the last time that your credit was accessed. You could have had changes in your credit report data that led to a different credit score. And it could also be different credit bureaus are using, okay? So like we talked about in Canada, it could be either Equifax or TransUnion. These each have different analytics and different algorithms they use to help determine your score. And banking doesn't help or hurt your credit score, okay? It's a common misconception. It's only things like when an overdrawn account, example, is delinquent for a while and that goes to collections, then that's going to negatively affect your credit, but not things like deposits and withdrawals, okay, guys? What actually does negatively impact your score, okay, that's things like missing or making late payments. Did you know it takes 24 months, okay, that's 2 years to remove even just one late payment on your account, just one. That's why it's extremely important, okay, absolutely crucial that you're always making payments to this, even if it's your minimum, okay, because that shows initiative and it's going to have a good impact on your score over time. Also, having your revolving credit at capacity, okay, that's like when you're maxing out your credit cards, that's going to have a negative effect on your credit score. We just talked about that recently. The FCAC, that's the Financial Consumer Association of Canada, okay, they suggest that credit scores are at their best when your credit utilization is at a rate of 35% or below. So if you had a limit of $1,000 for your Visa card, your MasterCard, instead of maxing that out, carrying a balance of $800, your score is going to be at its best if you were to carry a balance of $350 or below. A few more things that are going to bring your credit down. We've already spoke about them. Just a quick summary here, okay? Is closing your credit cards out, even if they're paid off, okay? That's just going to reduce your available credit capacity, which is worse for your score. Applying for numerous trades in a short amount of time, applying for loans from subprime financing companies, okay, those are the ones who give loans to riskier people, as well as having delinquent or collections items. And here's a big surprise, okay, something that's also going to ruin your credit score is if you have zero debt. Yeah, so many people think that debt is a terrible thing. You know, they want to have nothing to do with debt. They don't even want one credit card. But this actually makes you look bad on your part because you have no credit history. If you have no credit history right now and you're having trouble applying for things like a credit card, you can always apply for a secured credit card, which is something you put a down payment on for, okay? You put a deposit on there with your own money, say $1,000, and then that secures your credit card, and you just use it like a normal credit card from there. The provider reports your habits to bureaus like normal, and this can give you some extra points with an account with good standing. So those are all things that are going to contribute to worsening your credit score, okay? So guys, just try not to do those things. So obviously, with all these ways to ruin your score, you're probably wondering, if you haven't figured it out already, then how are you going to improve your credit score, make it better? Well, basically, you want to do the opposite of everything we've already talked about, you know, the things that you shouldn't do. You want to be self-aware and you want to monitor yourself because fixing your credit really does take time. It's a process and you need to be diligent during this process, okay? You want to stay true to yourself and realize the end potential and the value you're going to gain from the process. So to improve your credit, you want to, number one, monitor your payment history, okay? Make payments on time, even if it's the minimum. Number two, you want to use your credit wisely, okay? Don't go over your limit, and if you can, try to keep your balance below 30% of your limit. Number three, slow down the opening of new accounts. Remember, this temporarily, it's going to decrease your credit score, and this stays on your credit report for 2 years. That's a long time. Number four is to keep old accounts open, okay? When possible, when it makes sense, because when you close an account, it's immediately going to cause an increase in the use of your available credit. So if possible, you know, keep it open and use it periodically. That way it's going to stay active. And number five, guys, is diversify with a variety of types of credit, okay? You don't want 3 credit cards on your report, nothing else, and you don't want just a phone bill. Try and have a mix of the things we talked about. That's the open, the revolving, and the installment portions, and this variety is going to help to increase your score. 2 of my best pointers, okay, also guys here, is to always be using credit, but to pay it off timely, and most importantly, pay it off in full. You shouldn't be spending money you don't have, and you can even set up automated payments to help with this process. And secondly, if your debt levels are over 50% of capacity, okay, 50% of your limit, then I recommend setting up a payment plan, okay? That means do a budget, see where you're at financially, and realize that you need to get on top of these things now, okay? Really focus on making regular contributions to that debt and focusing on chunking that down. As we talked about in earlier videos, we don't want that killer debt snowball, you know, rolling down the hill your way. It's not just for applying for a loan where credit's important, okay? It's also relevant when it comes to things like applying for a job. It's entirely possible for a potential employer to pull your credit and then deny you the job based on your credit history. This actually happened to me last year when I graduated university, and then I got an interview for the credit union I currently work at. They pulled my credit as a condition of the acceptance, and you know, luckily my score was good enough and I ended up getting the job. But if I didn't start learning these things, you know, 1 year, 2 years before, and start trying to clean up my act a little, then that could have been the difference between me getting this job and, not getting the job. Your credit score can also be used when trying to do things like pick up a rental car or even applying for rental housing. Your potential landlord could ask to pull your credit score, and then maybe he could pass you up for someone with a better credit score. Because remember, this report reflects your payment and your credit history. So if you have a bad credit history, then you're more of a risk. And a landlord, they don't want risky tenants, okay? They want safe income, they want fixed income regularly without the trouble of, evicting people and having a vacant house for a period of time. It's also important for you to check or pull your credit once per year. What this allows for you to do is to go over your report, all the accounts on there, but more importantly, it allows you to check to see if there's any errors on there. Sometimes these things happen, an account can show up on your credit report that isn't even yours, it has nothing to do with you. So if you see anything that's unfamiliar, you can contact Equifax right away to try and get that cleared up. Whether it's by the error of the creditors who are uploading, reporting this info to the bureaus, who then accept it as accurate, or even special circumstances like identity theft or fraud. That's also common in the world today, especially with the online presence and social engineering. These could really have an impact on your credit score, so always keep an eye on yours. And that's all I got for you guys today. If you're still watching, thanks for your complete view today. I really appreciate the support. If you enjoyed this video, hit that like button, hit the subscribe button, share this with a friend or a family member. I hope I was really able to answer most of your questions regarding a credit score, your credit report, things like how a score is determined, what affects your credit score, and even how to improve your credit score. If there's anything else I might be missing out on or anything you might have thought of, let me know in the comments below. I'll be sure to follow up with you. Also, I got a really important video, a content-packed video dropping later this week. Hit the notifications bell if you want to stay in the loop there and know the second I release that. And follow me on Instagram at Boss Financial Channel, Get Social. And with that, thanks for watching. Stay positive. See you next time.